Investors Chronicle.
Hello, listeners. It's the Investors Chronicle Companies and Markets Show with you again, recording this week on Thursday, the 16th of May. With the FTSE still in relatively rude health, we're starting today's show with a look at Experian, the credit data business that topped the index leaderboard on Wednesday following publication of its full-year results. Julian Hofmann is here to do a bit of data analysis of his own and talk us through the figures. Our cover story this week, meanwhile, has a pretty lofty aim: how to create the ideal portfolio, with a particular focus on the common question of how many positions an investor should hold. James Norrington is on hand to discuss further. And finally, we're talking to PF editor Val Cipriani about another big question: how to work out how much to save for retirement. In many ways, the biggest question of all in investing. On that subject, I've looked up, just to depress us all at the start of the show, what percentage of journalists do we think in the UK are retired by the age of 60 or 64? Journalism, famously not a high-paying profession.
Is that before the alcoholism kicks in?
Well, yeah, I'm not sure if that accounts for lifestyle factors.
Yeah, I don't know many retired journalists.
Yeah. Well, the answer is 19, which might seem surprisingly high or surprisingly low, depending on your outlook in life. But there we are. We've all got a few years to go to get to that stage, but we'll come to that big question later on in the show. Julian, as I say, we'll begin with you. Experian, the full-year figures, clearly very well received, judging by the share price reaction. How did they strike you?
Yes, it was an interesting reaction for Experian. It sort of it's always a company that comes out of the blue with decent results, because it's a highly cyclical business, tends to go up and down with the general state of economies. But there is a bit of a lag time with it. So what we found with these results was that the fourth quarter turned out to be excellent. So particularly in the US market, which accounts for about 66% of Experian's total revenues. And the big variant in that market was how quickly mortgage applications have picked up, and the resulting credit checks meant that side of the business expanded at double-digit rates. That was quite a surprise, I think, for the market. But the question, of course, is whether that now is a lagging indicator, or whether that is a predictor of better economic indicators, like a solid housing market in the US, for example. But for that, in many ways, that's always been a slightly volatile measure. But really, across the board, at an underlying level, they achieved about 7% growth, and this went through, operating profits all across the line, really. And that's why the market was so pleased. So it didn't have any one-off problems. It's a very operationally geared business, so it only really needs to handle more business on top of its fixed cost base to make materially. So it wasn't really a surprise at the top of the leaderboard, but it was interesting that that fourth quarter, coming from a point where it wasn't doing anything brilliant, to the fact that the fourth quarter turned out to be so productive. I think that was the main surprise in the results, and why the market hadn't quite foreseen that.
Yeah, certainly that mortgage side, as you say, that was perhaps unexpected, albeit that is the big question, really, isn't it? How cyclical it is, and also how much of a macro play Experian is, because historically, I suppose, credit scoring would have been seen as counter-cyclical insofar as more people check their score in tougher economic times. At the same time, the business has moved on a bit, and there's lots of different parts to it now, and it's more cyclical than it was, perhaps.
Yes, yeah, you're right. Experian seems to think that if you sign up to their service, that you need to know your credit score every single week. You sort of follow it like a soap opera. But there is like in America, for example, the biggest market for them, credit scoring is a much bigger thing than it is here in the UK. You literally have to have a credit score for everything, even if you sign up for like a store card, like the equivalent of like a Waitrose card or something. You need a credit score for that. So there is a structural thing about that particular market where your people have to do it a lot more, so that generates more revenue over the course of the economic cycle than you might otherwise expect. But they are alive to the fact that they're not they can't be a one market business, so they've expanded quite a lot into South America, and it was also the South America business that delivered some interesting growth this time around. So the group operating margin is something like 27%, but if you go down to South America, the operating margin is more like in the mid 30s. So it's a higher growth, higher value market for them. Obviously, it encompasses growing emerging markets like Brazil, or relatively well-off middle-income countries like Chile. That has the potential to balance off this very dominant US business, and I think the market also liked the fact that the investment they put into South America also seems to be paying off in terms of much higher overall margins. And so yes, it's proving to be an interesting business, an interesting year for them, and whether they can keep up that growth rate the next year is going to be the key for how the share price continues. It's been on a very good run. It has the interesting anomaly that on a quarterly basis it tends to dip and then go back to its long-term average, so it doesn't fall below its long-term average for very long, and it's roughly at about 29 times earnings at the moment, which is pretty rich, let's face it, in the context of the FTSE. But they've become so consistent that I think that the market has kind of given them a pass and decided that because of their expanded margins in certain areas, that they're still capable of further growth.
The Brazil aspect is interesting. From what I've seen, there is some reform in that market, so that the credit scoring process is becoming a little bit more like the US market that you described, insofar as you need it for more things now. So that could be a structural driver there. Share price wise, whatever you can say about credit scoring, a lot of the rest of the business is quite cyclical. Credit flows, credit tightness, mortgage market tightness, and vice versa will have the same kind of impact on Experian. And yet this year, we've seen now good results this week. We saw at the start of the year in January, I think, a third quarter performance at the upper end of expectations. The shares have had a good run, as you say, at a time when actually US rate cut expectations have been pushed back. So is there that tension, isn't there, about whether there'll be this soft or no landing in the US, and whether it requires lower interest rates for Experian to flourish, or if it's a case of, well, the US economy is ticking along okay and it will be able to benefit from that insofar as there's no recession coming?
Well, it's an interesting one, because the difference, the sort of anomaly that you're referring to really is the sort of business services side of Experian and the consumer side. And what was clear in these results was that it was the consumers that are driving the growth of credit checks at the moment, whereas business services is growing, but not anywhere near as fast, at least 2 percentage points slower. And that tells you something interesting. It tells you really that US consumers still have a bit of confidence at the moment. So you get a credit check when you need to get a car or something, or big ticket items, and this, or getting new cards as well. The consumers are running ahead of underlying businesses, but if you were an economist, you would say that was the start of a change in the cycle. So when consumer spending starts to overtake the growth of underlying business, that's usually a sign for worry. So you think, you're not sure. It's a mixed kind of picture, but what you would then expect is if the consumer side starts to pull back, that the business services picks up again. So it's one, or I don't think it's a 50. I don't think it's a zero-sum game in that sense, but there is a certain amount of caution, I think, in seeing how consumers are spending in the US versus how businesses see their own spending. And that is kind of being picked up in what Experian is looking at.
What about its drivers of growth aside from the underlying economy? Because there are new business lines it's moving into. Its marketplace is a relatively new business line, which seems quite interesting in terms of what it does. Tries to automate some of that credit approval process as far as I understand it. Is that something that has some potential in future as well?
This is where you could talk about AI, isn't it, in terms of improving their business process. So basically, the marketplace concept, it's a way really of automating of also what they do. So a lot of credit checking is done by people in an office looking through records. It's a very manual. It's often a very manual process. It takes quite a long time to bring information together. And Experian is hoping to develop a product line that will fully automate that process and make it an easier way of getting a credit score to the consumer. And it's hoping to do that partly through a sort of kind of subscription-based model. So what it's aiming to do is to have more of its business generate recurring revenue at a very high level. And that should then remove some of the cyclicality out of the model, out of the business revenue streams. So that is one way they're looking at it. I think is through that AI type investment. They didn't say a lot about it in these results, but I'm assuming that when they have their next capital markets day, that will be the time that they'll highlight what investment they're making into it.
The idea as well, isn't it, is to, if you have a business which wants to target a certain set of income, a certain credit score type of people, then they will effectively pre-approve these products for those segments and market to them with lower upfront costs. So clearly they think that's something which can work better in future than the existing ways of doing things, but we'll see how that takes off. Why don't we conclude by just going back to the valuation a little bit? You talked about it before. We've said it's had a good run. I think it was at a bit of a discount to US peers, but that's probably closed up with the recent run.
I mean, I kept them on a buy. The interesting point is that they're not, in relation to their own valuation, they're not either at a premium or a discount. So they've maintained a valuation of about 29 times earnings. I think Colfax is slightly ahead of them at 30, but not by much. The good thing about them, in the sense if you buy them at that level, it's certainly not the cheapest share you can find on the market, but there's something about the predictability of the underlying earnings that keeps that very stable level of valuation. It hasn't changed a lot when you look at it over a 5-year period. So that's why we decided to keep it as a buy, and because in relative terms it's not actually moved a huge deal when it comes to the underlying PE valuation.
Yeah, I think we have to accept nowadays, don't we, that you're going to pay a premium for data-led businesses, whether it be Experian or things like Relx in the UK or many other things elsewhere. You can now get 12 weeks of an Investors Chronicle print and digital subscription for just £12. You'll get instant access to our website and our app, plus the magazine delivered to your door every week. Check the terms and conditions in the show notes for more information. We're going to move on now, though. We're going to talk about the cover feature this week. As I say, that's looking at the ideal portfolio, the ideal number of shares to hold. Of course, there is no one answer to this question, as with everything in investing. But James, can you talk a bit about the thinking behind the piece to begin with, about why you're looking at this in particular and why the question of how many is important in investing, how many ideas?
You preempted my caveat there that there is no real. So the ideal portfolio does depend. It's ideal for you personally as well. So that's kind of a thing. But the thinking behind this was as we're sort of entering a period where we're potentially looking at more dispersion between individual stock returns, and there's always this sort of debate between people who invest in shares. How many should I hold? How much should I go for concentration versus diversification? So really, it's the thinking is about the framework for your equity allocation, but then looking at that within the framework of a broader asset allocation, which actually helps you spread your risk. And actually, by diversifying with other assets, it'll help you sort of to concentrate your risk budget with some of your best ideas in stocks. So that's kind of one of the key premises of the feature. But other than that, it's also looking at different stages of your investment life cycle. How many individual shares would you want to hold? And that will depend on things like the size of your portfolio. For smaller investors, earlier on in their journey, you want to be able to back your best ideas. That's one of the best things about being an investor. It's very rewarding to pick individual stocks. It's a very valid thing to do, but it's how do you maybe mix that with some brute force diversification with a tracker, and as you get to have a bigger pot size, how many more individual shares can you hold? But there is a diminishing returns. You don't want to become a closet tracker by holding too many individual shares, and equally there's a question of time, and a lot of the feature is based on some research. It was done on basically the ideal number of shares. Best Ideas, I think the paper was called, which was picked up by another guy, Thomas C. Howard, who wrote an article for the CFA a couple of months ago, where he was discussing, how fund managers, if they concentrated on their best ideas, their returns would be a hell of a lot better, rather than sort of becoming closet trackers, which largely they do because of their obsession with risk metrics. So the feature tried to balance out risk metrics with the principle of going after your best ideas.
Can we say a bit more about the research? What this Best Ideas paper? What did it find? Well, specifically,
the original Best Ideas was it was a group of academics, and it was looking at the diminishing returns after about the best sort of 20 to 25 ideas that investors have. That after that it drops off, and that's due to the amount of time and research that they have for their best ideas. Thomas C. Howard, he adapted that slightly. He looked at the most often held stocks versus the least often held stocks, and he found that the most frequently held, rather, so not the biggest positions overall, which they tended to outperform, and he took that as a proxy for highest conviction investing, and finding that that basically, if your best ideas, the ones you got the most conviction in, do the best, then actually maybe you can outperform the market by picking stocks, and maybe that the industry, largely due to the fact that that they have certain constraints and certain risk management constraints, and you can't be constraints too concentrated, that they're underperforming unnecessarily. So really, we wanted to adapt that for a private investor who doesn't have that sort of professional risk that a manager has.
These most commonly held shares and least commonly held, he was defining it through the prism of as held by the best US equity funds over the past decade, wasn't he? So he used a set pool, looked at the most popular shares in that pool of funds and went from it in that direction. And of course, we have a version of that ourselves, which you adapted for the feature, which is our Ideas Farm best and, well, it's effectively the similar system which we run in our pages each week, the most popular types of shares in different sectors.
In the Ideas Farm in the IC, we have global equity fund managers' most popular shares, and we also had UK. We've got several, but those are the two that I took, the UK most popular shares. And I just took a few ideas from those. The ones which had, in the last time that we ran it in the magazine, and I looked at the companies which have actually seen positive momentum in terms of becoming sort of favourite ideas of our a number of fund managers. I mean, there's an element, of course, of sometimes winners become overweight because they overrun, so that there is that sort of that consideration. But on the whole, that will be representative of high conviction ideas. So I these weren't my own picks. I just picked them mechanically, and I just took a number of those, and I shoved them in a model, and optimized a portfolio, an equity section of a portfolio, based on blending those ideas. And I actually took a best small cap idea, so I took 10 ideas in total. I blending that with a UK tracker and a global tracker, with minimum limits for the UK and the global tracker to give us some brute force diversification in there as well. The reason I chose 10 stocks was actually because I did it based on another model, and I was assuming £100,000 in equities. Now, many people with a bigger investing pot than that would actually get higher utility from having more than just 10 individual stocks. So I'm not sort of saying, you should only hold 10 stocks. The reality is if you've got more money, if you say had a 300,000 or a 500,000 pound portfolio, then you might want 25 individual stocks. You could manage that. And if assuming you've got time, then you could manage that type of holding and you probably get more utility and need less of the sort of the brute force diversification with the trackers. But you do need diversification across asset classes, which is where thinking about it all in the framework of an asset allocation is important.
Yeah. We go into detail in the piece of how that allocation works, which maybe we'll save some of that for people when they pick up the magazine or have a look online. But why don't we talk about individual position weightings as well, because that's something else that people often wonder about. You've alluded to it when you talk about running your winners and those position sizes getting quite large, but are there some rules of thumb there as well to think about how big one single position should be getting if it's an individual share?
I think there's no point holding anything below about £2,000 for an individual stock. That was just a sort of rule of thumb, and that would probably increase that threshold the larger your portfolio gets. And I also set an upper limit of 5% for an individual position, bearing in mind that you don't want to get you're going to be concentrating on some of the global picks anyway, because they'll also be replicated in a global tracker. So, for example, the whole thing, you'd have been fairly overweight Microsoft. You'd end up having sort of 7.5% of your equity allocation at one company, which isn't excessive given its importance and its prospects, but it is an expensive company, and you need to be aware of what you're holding and if sums in. But that, so those are sort of rules of thumb. I set limits because I was thinking from the point of view of an investor who only had 100,000 in equities. That I had a lower limit bound for how much should be in the brute force diversification of the tracker. And the whole idea is really is just to balance the benefit of being able to take concentrated positions, rely on your own convictions, include a couple of smaller cap companies that you have high conviction in, as many of our readers enjoy doing, and it's a perfectly valid thing to do because you can get very high returns. You're not going to get you get multi-bagger returns if you sort of follow sort of Simon's portfolios down the years. Basically, so it's sort of the best of both worlds, as it were.
Yeah, and it's combining that, as you say, with the tracker ballast in the portfolio to blend these two ways of investing, ultimately. What about the dispersion aspect you mentioned right at the top? Because that can also influence things within this framework. How much correlation, how much dispersion we're seeing between shares can influence how many shares you hold as well.
Well, importantly, in terms of this question of the ideal number of shares, I mean, that was... I worked that out mechanically using a model based on the work by Mayshar from 1979. You can assume a certain level of correlation, but you're looking at price or the cost of holding individual stocks and using that as a proxy for how your utility versus the benefits of diversification will sort of help you diversify risk. And there's a diminishing returns after a certain point, which is why you get to a certain number. Now, interestingly, if you've got a certain size pot, then you'll get more utility from holding more stocks, which is why for smaller stocks, because that runs up against diversification theory, that's why you need to split it with a tracker when you've got a lesser pot. So you'd be thinking the level of correlation is going to affect how much diversification is important. If there's higher level of dispersion, then you get a higher benefit from holding more shares. So if you assume in periods of very high correlation between equities, high beta periods, as we saw in the easy money period in the 2010s, you could assume a high level of correlation with stocks across the index, and so you'd get less benefit from diversifying across more individual stocks. You might as well just buy. You could either buy a tracker or you would get more benefit from being quite concentrated in the absolute winners. Whereas when there's more dispersion, there's you're going to get more benefit from diversifying across more winners. So becomes more of a stock pickers market. If you make that assumption, then you'd want to hold more shares. But obviously that there are always economies of scale, and when we have a small pot, then really it's never really going to be worthwhile holding 25 stocks if you've got a £10,000 portfolio.
Mm. Yeah, you've got to have things that move the needle. Of course, we should finish this section by saying, as you did at the top, that there is no one ideal portfolio, or as I said at the top, but as very much in line with your thinking as well. it is very much about this in the framework, in the context of each individual investor's risk appetite and time horizons as well, and what have you. We're not really getting into that so much in this discussion, but that's the broader framework of how you balance your risk assets, your equities with other assets. We talk about that in the piece as well, but we're not going to right now because we're going to move on to the subject of time horizons by talking about, I suppose, the ultimate aim of having an ideal portfolio is having enough to save for retirement. Of course, some people would like to save to pass on to future generations or to give to other people as well, but clearly saving for retirement is a big aim for all investors and wanting to take a step back and enjoy a more relaxing life, perhaps. Val, you've been looking at this week through the prism, first of all, of cash flow modeling, which is a very boring phrase, but something which financial advisors in particular put a lot of stock in. When you go, if you go to an advisor, if you ever do, the way they tend to justify their charges and what have you is by saying, give us your information, we can then effectively put this all into a system and tell you what you need to do, where you need to be to retire in X many years' time. However, there are a number of tools available for free which can help investors with this themselves. What did you find by looking at these and by trying them out? What are the basic things they offer, first of all?
I wanted to kind of like see where you could get yourself without sort of paying for an advisor. And I think the thing that struck me the most is that actually you can get quite far, like maybe a bit more further than I thought you could, because the tools that are available for free online, some of them at least, are more advanced than maybe I'd originally thought. Obviously, it's not the same thing as you get access to with a financial planner, but you do get quite a bit out of it. And basically, the way they tend to work is that they will ask you a set of questions about, first of all, your goals. So, generally speaking, how much you want to have in retirement, and then some more detailed things like, for example, do you want to take your tax-free lump sum? Do you want to leave an inheritance? Do you want to help your children out? This sort of thing. And then they look at what you have already and what you are able to save or to contribute to your pension. And then they will, use a set of assumption in terms of, for example, investment growth, inflation, that sort of thing, to try and calculate how close to your goals you are, and whether you kind of like need to change your plans, which could potentially mean saving a bit more or thinking about having a less maybe lavish lifestyle in retirement. And then they can also tell you, what happens like according to different scenarios. So, for example, if something goes wrong and say there's a market crash right after you retire, would you still have enough money to do that? So I think the main advantage of trying out this kind of thing is that you don't, if you're trying to plan for retirement yourself, inevitably doing the maths is going to become quite complicated because there are a lot of factors to account for. So these tools just do it for you, and they have a sense of the assumptions you should be using, which is normally quite a difficult call to make, I think, for people. And then the other thing is that they generate like a nice graph, so you can sort of like visualize it instead of just seeing a lot of figures.
Yeah, it's about getting you closer to having an idea, isn't it? Because there are always going to be assumptions, of course, that's a part of life. But equally, I think people can, when they're starting or even when they're midway through their investing journey, have a very uncertain sense of where they want to get to or how much they would want to save. Ultimately, of course, life happens, to express it politely. So a lot of these things could change along the way, but it at least gives you a goal or some goals and to focus on and some options to keep in mind. Those are the basics of these programs, but there were three three tools you looked at in particular for this feature. Could we talk about some of the features that they offer? We don't have to go into each one of them, the pluses and minuses, but just a few of the different things they offer and what you can get from these different services.
Yeah, so I've tried a few. I think the main ones were called Truth About Money, My Net Wealth, and Guide, double I. I think no one of them has everything, but depending on kind of what you want to prioritize, you can try different things. So the Truth About Money one is a bit more kind of like basic in terms of the way the things are presented, gives you a bit less personalization, but it's quite nice that you can build a plan for two people. So if it's yourself and your partner or your spouse, you can kind of just like put all the information about the two of you together and see whether both of you as a sort of combined unit are on track to get where you want to get. And then quite briefly, My Net Wealth is quite good for investors because it also allows you to track your assets and portfolio, even if you have them on different platforms. So you kind of like see your overall asset allocation, and then it uses that information to build a retirement plan like the other ones. And then Guide, I quite liked because it has some specific things that are quite clever. So, for example, it lets you like personalize how much income you might need at different points in retirement. And it's really good at showing you what happens and how the scenarios change if something goes wrong. So, for example, again, market crash, if you need care fees, that sort of thing. I think the other thing is that both My Net Wealth and Guide are quite good in terms of sort of overall experience and visuals and that sort of thing. So overall, it's quite a pleasant experience. Like, it's not overly complicated, I think.
Pleasant until you see perhaps how much you need to save in
Yep,
order to
yep.
retire. There are also US options which offer their own level of personalization, albeit with some drawbacks because the tax system is completely different, et cetera, et cetera. Is that correct?
Yeah, that's right. I think there's quite a few of them. I've tried one, which is the Financial Mentor's Ultimate Retirement Calculator, quite a name. I think generally speaking, with the US ones, you want to be very careful because it's very easy to get like something wrong. Like, you assume that something works in the same way as it does in the UK, and then it does not. So especially when it comes to taxes, as you were saying. And then the other thing, so this one I tried is very, very personalizable, which is quite nice because you can really see, if you want to have different assumptions that the ones that the standard calculators assume, you can try them out. So you can really pick, the rate of inflation you want to use, the investment growth you want to assume, all these kind of things, and just set all the parameters yourself. But I guess the flip side of that is that, as I was saying at the beginning, it's kind of a lot of judgment calls to make yourself if financial planning is not your full-time job. And I think it can become quite confusing and overwhelming because, again, you have to think that you're planning for, 3-4 decades. So obviously a small difference in one number compounded is going to make quite a big difference in the final result. So yeah, it's very, very easy even for people who are, very comfortable with investing, I think, to get a bit overwhelmed when using something that is too easy to personalize. So yeah, maybe I would stick with something that is A, UK based, so somebody else has done all the work on taxes and that kind of thing, and B, maybe use the assumptions that somebody else who does that as a full-time job has picked.
Especially when it comes to investment growth and inflation. Of course, both of which are impossible to know, but we can only go on the historical bases for those. Is probably wiser than plucking a figure out the air. We do have details in the article about these particular services, the My Net Wealth, the Guide, the Truth About Money. But let's end by talking about a feature you're writing for next week's issue, which leads on very nicely from this one, which is the biggest question: how much to save for retirement? As with all questions, but no doubt this one in particular, everything boils down to the individual, and it's an unanswerable question in many ways. But I imagine there are some things you've been looking at for this piece that are quite useful maybe to mention in terms of what people need to consider, or even what people quite often forget to consider when they are debating this question in their minds.
Yeah, 100%. I think, the main caveat is that, the best way of doing it is basically what we were saying before. So, go and try and build a bit of a financial plan and figure out what you need for yourself, because there is not one answer for everyone. But the feature does look at this idea that there's quite a lot of things that people tend to underestimate. And so the general impression is that you might need more than you thought before to retire in a sort of comfortable way. And so it does look at what these factors are that are kind of like gradually pushing up the cost of a comfortable retirement for people, and that people tend maybe not necessarily to think about as much. And so some of these things are, I think that the first one that always came up when I was talking to advisors and planners is that people tend to underestimate how much they're gonna need in terms of income in general, because they think about saving on commuting, saving about lunches that they get at work, all this sort of thing, and they assume that they're gonna need much less. But actually, it is true that you do suddenly have a lot of free time, and that, you know, to occupy it, you might want to spend quite a bit of money, be it on traveling or you know, having more meals outside, socializing more, all this sort of thing. So that's one. And related to that is obviously the question about inflation. There is both, I guess, good news and bad news. Good news because I think in the past couple of years, we've all been panicking about it a little bit because it has been so high in the short term. And I guess quite a few people must have been wondering what it meant in the long term for their plans to retire in, say, 15 years or something. And on that note, I mean, long term, it does smooth out quite a lot. It doesn't make a massive difference to a long-term financial plan. Is for 1 year, we have very high inflation, and then it kind of eases back down. But then on the subject of sort of not underestimating how much you're going to need in terms of income, you should sort of think about the fact that the things you might want to do more in retirement might sort of become more expensive more quickly than other things. So for example, the cost of traveling, inflation on the cost of traveling tends to be higher than, say, inflation on the cost of food. So basically, if you're going to be doing a lot more on things that become more expensive more quickly, it is possible that your personal rate of inflation is higher than the sort of average rate of inflation that the rest of the country is looking at. And on this note, I mean, care costs are one that sort of all the advisors mention because they go up more quickly than the rate of inflation. And obviously, when you're in your 50s or early 60s, it's not necessarily something you want to think about, but they might be worth including to a degree in some sort of plan, or at least consider what you would want to do if you found yourself, unfortunately, in the situation of needing some care in the future. And then I think the other thing is life expectancy, which is one that is quite confusing to plan for, because I think I don't think any one of us think they're going to live to 95 or 100, but the truth is that nowadays quite a few people actually do. Even if it's just 1 in 20, there is still a lot of people in the grand scheme of things. So yeah, quite a lot of conversations about making sure that maybe your pension pot lasts a bit longer than you might have previously thought you would need.
I think I'm going to live to 95 or 100. Actually, I haven't really considered it. It's a long way away. I do sometimes wonder about how much one needs in retirement. The question, you're right that you can underestimate a lot of things, be it inflation or care costs or the amount of activities you do when you first retire. But personally speaking, I always think, parsimonious enough, I'll get by. But maybe that's just thoroughly blinkered thinking, not taking into account all those other things. Well, all of us, to go back to the question right at the top, have got several years, several decades until that situation comes to pass. So we'll cross that bridge when we come to it, I suppose. But hopefully this discussion has been useful for people thinking about what they need to do, what they need to consider. Those features are in the magazine this week and next week. And that brings us to the end of today's show. Thank you very much to Val, to Julian, to James, to our producer, Vic Thornton. We will not be doing a podcast next week. We're having a week off, but we'll be back in 2 weeks' time with another Companies and Markets show.